Hey guys, today I'll be talking to you about 3 different values that investors may use to look at the earnings of a company: EBT, EBIT and EBITDA, and essentially the differences between them and when to use one and not the other. So essentially, we can start off with the earnings of a company. The net income is the profit that the company actually keeps after all of its expenditures of any type. Then we can move on to EBT, earnings before tax. So what this value does is it takes into the account that the tax is paid of a certain company and looks at the earnings before them. What does this do and what's the reason behind this? Essentially, is to allow for the comparison of companies which operate in different countries and essentially within areas which charge different taxes. So for example, the same company X is going to pay different taxes in the state of California or wherever the hell than like the country of Poland. So for a fair comparison, EBT is used. Then we move on to EBIT. So it also takes into account interest, earnings before interest and tax. And the reason for this is, again, depending on the company that you're looking at in the firm, you can also take into account the interest paid upon loans. And on top of that, EBITDA, it also takes into account the depreciation and amortization. So these two terms, essentially depreciation, it means the loss of value of a certain asset over a certain period of time, usually hard assets like machinery. And amortization is essentially the spreading of a cost of an asset across a certain amount of years instead of all in one lump sum. So essentially, how do these kind of figures fit into what industry? Like I said, it depends on the firm and it depends on the industry. So within a capital intensive industry where, let's say, a lot of hard assets need to be bought or a lot of machinery is very capital intensive, like mining, oil and gas, and for example, food processing, it's actually one of the firms that I'm looking at now. I chose to use EBT for that company because with EBITDA, the depreciation and amortization of these hard assets is a real cost. A lot of these machines that they're using are going to lose value and they're going to, stop being usable in, let's say, 40 years. So it's a genuine cost to the firm. On the other hand, if you're looking at a firm which is developing software, you've got, let's say, me and a few friends, we're in this room, we're in the office, and we're all typing away, creating a code, a software or whatever. The depreciation is little, but the main point is that some people see depreciation as a essentially non-cash cost. So obviously you're not losing money each year, you're not having to pay out money, and therefore some people include that in the actual calculation of real earnings of a company. Again, that depends on the firm, because on one side of the aisle, where it's where a firm industry in general is very capital intensive, depreciation and amortization is a genuine cost. On the other hand, some people might think that actually depreciation is a non-cash cost, which is not going to cost us anything in the future, because when I buy a machine, like I said, it's going to run out in a few years. But if I'm developing some software or whatever on my laptop, the depreciation of my laptop is, I'm not going to pay that cost. Again, it depends on the firm specifically and what they're doing and how, their operations, but that's the general distinction between that. So what are the impacts of using one value over the other? Well, essentially, if you start off with just the earnings of a company, it's obviously the lowest value. If you add on the taxes, it usually obviously increases, interest as well, any sort of payments which lead cash out of the business. When you put it in the calculation of the actual earnings of a company, the earnings tend to increase. So let's say if I'm looking at a mining company and they've got a lot of machines lying around, if I were to use the EBT metric, I would essentially take into account all of the costs on the machinery and essentially the money lost upon using this kind of machine when I sell it in the future, or if it just stops working in the future. So obviously the earnings tend to be lower because I take that potential non-cash cost into account. Whereas if I was going to use EBITDA, I wouldn't take that into account. I wouldn't see it as a cost. So for example, I would obviously add on my D&A, depreciation and amortization, into my earnings calculation, and all of a sudden my earnings will be much higher because depreciation and amortization in these, like I said, capital intensive industries tends to be very, very high. So it's really significant, and that's why it's sometimes advised not to use EBITDA in these kind of industries. But essentially, what would that mean? With these kind of EBIT or EBITDAs, these metrics, what you can use is take the EV to whatever ratio, and that's That's a metric used by investors to look at the potential valuation of the company and essentially whether it's over or undervalued. So just using an EBIT or EBT metric in respect to the enterprise value, which is the EV part, you're going to have essentially a moderate ratio figure. If you were going to add earnings onto that, or essentially add on the depreciation and amortization, your EV to EBITDA kind of ratio would be lower than your EV to EBIT ratio. And with that ratio, the lower it is, the potentially more undervalued the firm is. So what that leads to is what's called a value trap, essentially showing you a low multiple of the ratio, meaning that the firm could be undervalued, but in reality it's not, because the depreciation and amortization are genuine costs of the firm. So you may think it's undervalued, you may put your money in the business and then find out that actually the stock's not going anywhere, because in reality the costs of the depreciation of the machinery are very high. So that's really what this video is about, and the kind of main differences between the metrics. There's also many different metrics, because depending on the business, depending on their costs, you'll tend to use the different metrics. There's many more, you can add amortization, not depreciation. I mean, you can play around, you need to substantiate it, like I have now, for example, for the food processing or mining business of company X, and see which one will give you a true value of the earnings of a company. Because otherwise, you're going to get an incomplete figure. Obviously, you're either going to see a company that's overvalued, that is actually undervalued, or vice versa, and it will lead you to make wrong investments. So that is in reality, like I said, the difference between the three. I hope you've enjoyed this video, and I hope it has helped. Thank you.